Sean, it seemed like a solid report overall, but what do you make of management's decision to lower its full year sales estimate?
Yeah, it's interesting. Obviously, that's been punished elsewhere as you look at Dollar Tree earnings. It's a very challenging environment for consumers. It's an extremely price elastic category. Consumers are reining in spending on the good side. We see that. We saw that with Dollar Tree. We saw that with Family Dollar. Obviously, profitability was a bright spot. I think that's what the market's reacting to. But as we plan to lower our $100 fair value estimate by a mid-single digit percentage, we harbor a couple of longer term concerns for the retailer. We don't see any real ability to drive an inflection in sales growth in this industry, particularly as sales continue to migrate online. And then one of the callouts that gave us a little bit of concern was the nod to normalizing credit card charge-offs. So for Best Buy, we estimate that that's about 25% of tender and as much as 20% of operating profit. So if we were to see that tick up even incrementally in 2024, that could be a pretty meaningful headwind.
Speak more to that particular data point. How much worse can those charge-offs get? And is that a ripple effect we might see beyond Best Buy?
Yeah, I think that's a reasonable conclusion to draw. There are a number of retailers for which these co-branded credit cards are a meaningful portion of operating profit. You look at Macy's, you look at Kohl's, Best Buy obviously has a pretty large program. And the problem is that we continue to see sort of higher than normal levels of profitability, lower than normal levels of provisioning and charge-offs continuing in the space, that the U.S. consumer continues to remain healthy, but a lot of the leading indicators are starting to point in the wrong direction. Consumers are assuming a little bit more debt. We're starting to see sort of a larger balance of rotating credit. And in the long run, if we were to see that continue to deteriorate, that could eat up a pretty large portion, as much as 1% of Best Buy's operating income.
What about the idea that they put forward that things are getting better? What is the upside risk that they present here? And the idea that maybe they make it out of the woods here in terms of, this being the worst it could get when it comes to some of the softer data they're seeing?
Yeah, they just might. It's a good point. So there are a couple of positive signs here. Obviously, the industry is sort of the tide that raises all ships. And we are at a point where after a demand pull forward in 2021, we're starting to see sort of sales flatten and hopefully inflect next year. It depends a little bit on how consumers are feeling moving into 2024. Part of the problem is we're still in this weird phase where consumers are not yet running into replacement cycles from the phones and the laptops and the entertainment devices that they purchased in 2021. Hopefully we get to that point, and that would certainly provide a meaningful benefit to Best Buy. You think about, if you purchased a phone in 2021, you may not replace it until 24 or 25. And we're running into similar effects with entertainment and with home office setups. Also, what we're starting to see is as the firm has rolled out a 3-tier loyalty program, you're seeing a little bit less cannibalization of what are really profitable services. You think about installations, you think about warranty touch points. And to that effect, a bright spot was we saw services revenue tick up almost 8% in the quarter, and that's really high margin revenue. So the combination of those factors could potentially provide a little bit of near-term upside for the name.
And Sean, looking out long term, it feels like shopping increasingly has moved online. You have the likes of Amazon being the first choice for a lot of consumers. Then you think about a firm like Best Buy, which has a lot of physical locations. It has a lot of brick and mortar presence. How does it shift some of those customers online? How does it deal with the Amazons of the world?
Yeah, it's a great question. Best Buy obviously under indexes to online sales. They do about a third of their sales through online properties. Industry-wide, that figures about 55 or 60% of consumer electronics sales come through online channels. So there are a couple of levers there. Obviously, they called out the development of the mobile app. About 20% of their digital sales are coming through that channel now, and that's fairly incremental. They've obviously tried to push consumers in that direction with the loyalty program, with Best Buy Total Tech, with Best Buy Plus. And that's been met with some degree of success. If you think back to pre-pandemic, the firm was only doing about 19 or 20% of sales through that channel. But obviously they under-index there. And the other point to call out is that channel is it carries a lower profit margin for Best Buy than would an in-store sale. So they find themselves in between a rock and a hard place in some ways here. And even as they work to take costs out of the P&L, as you think about automating certain chatbot functions with AI tech, as you think about sort of getting employees to float across multiple departments. In many ways, Best Buy is really running in place, and we think that they'd be lucky to get back to that 4.5 or 5% gap margin figure moving forward.